There is a phrase that comes back every single time the market turns: distress equals opportunity. You hear it from sponsors, you will read it in the headlines, and it feels true because it sounds like now is a better, safer time to buy. But a discounted price and a good deal are not necessarily the same thing, or I should say, durable deal. So today I want to speak to the difference because confusing the two is an important distinction and could lead to one of the most expensive mistakes a capital allocator can make. But before we dive in, for those who may be tuning in for the first time, my name is Vessi Kapurian, former commercial lender turned investor, family office and board advisor, and entrepreneur. Today, I work with family offices and their family enterprises at the board level, as well as with private investors, guiding them on deal due diligence, deal underwriting, and passive investing. So, here is what I've learned watching and living through more than one cycle. The discounts and distress are real. I'm not here to dispute that or stand here and tell you that they're imaginary in any way. That is not the case. When the financing gets expensive and owners cannot refinance, motivated sellers inevitably appear and prices decline. That part is absolutely correct. The mistake is not believing that the discount is real. The mistake is rather believing that the discount is the whole story to the deal. Because every distress cycle seems to produce the same mantra and the same mistakes. Buyers basically treat the lower price as a margin of safety, and the lower price is not necessarily a margin of safety. It's just a lower price, probably more reasonable price. And we're living through that today. Oftentimes, when deals come across my desk, they're being presented as we bought it at a discount, dot, 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 from the peak. Well, yes, hopefully you're buying it at the discount from the peak of the market. And we all know about what happened in when the Fed started raising rates, right, in 2022, and we all know what happened before that. And if you are tuning in for the first time, I have a lot of content about it. So happy to connect you with the right link or just connect one on one and chat about it. But what I want to do today is reframe that position because the condition that created the discount do not necessarily close when you buy the deal. You actually inherit those conditions. So let me walk you through three of them. There are more, but we'll be here forever if I go through that in depth. So just want to highlight three of those. First is you're taking over, you're inheriting the financing gap. And so the reason the prior owner is selling it at discount, or one of the reasons, is that often they could not refinance on the terms that worked in their original projections or that they hoped to achieve. And that gap doesn't necessarily disappear because you signed the purchase and sale agreement. It simply transfers to you now. Now it's your gap to solve on the same asset in the same market. Second one is negative leverage, and I've spoken about that at length, but in a lot of these deals, the cost of debt today, at least in the current environment, is higher than the yield the property produces on day one. And so that is not automatically fatal, but it does not fix itself. It has to be underwritten to a very specific time bound path back to positive leverage, back to stabilization. And if your only plan is that, oh, rates will come down and rents will rise, then that's not a plan. You have a hope. And as we all know, hope is not a strategy. And third is the reserves and the deferred capital. A distressed seller is usually distressed in part because they rent the property thin on reserves, maybe thin on maintenance, thin on capital and the capex that the asset really needed. And so when you buy at a discount, you're buying that deferred work and an empty reserve account. And so those just come with the keys, and it's something that you have to account for. And so here's the consequence that ties all of these three together. So the discount, maybe the market pricing problem that you're about to inherit. And so, with that in mind, I want to talk about a real deal that I had looked at, and I am changing some of the details again to protect the confidentiality of it, but the sequence of events and the nature of the events is real. So, a sponsor had bought a deal that looked like a textbook example of a distressed opportunity. Property was running at below 90% occupancy. The price reflected that condition. It was down from the peak, and the seller's line term loan was maturing, and so the thesis was simple on it and on its face quite reasonable. So they believed that the prior owner had mismanaged it. I hear that a lot. Oh, the prior owner did a poor job, and we're going to do better. And that's often the case, but not always. But in this case, they thought they could operate it better. That wasn't their first rodeo. They had owned and operated multiple properties prior. But here's what they had missed. And I'm not quite sure if they didn't do diligence on the market or why exactly that happened. But the ultimate factor that was actually constraining top line growth in that particular deal was the local regulatory limit on evictions in that particular market, and staffing shortages really, and also processing evictions, even if those evictions were not contested and fully valid. And so the prior owner had not failed to fill the building out of incompetence necessarily, but they were boxed by a rule that the new buyer also could not really touch, not something they could control. And so the sponsor had bought what they thought was an operations problem, when in reality it was a regulatory constraint problem. And you cannot operate or out operate such constraint because it's out of your control. Secondly, in today's environment, the expense reality is real. We are hearing about insurance premiums increasing, labor costs, hence payroll, material costs, hence repair, maintenance, which also has a labor component in it. All are higher than their model had assumed. And last but not least, when they bought the deal, they had very, very thin reserves. So when the pressure hit, especially at the top line level and then at the expense side, there were not enough reserves to carry the bleeding for long enough. The sponsor issued a capital call, but unfortunately, that was not enough to save the deal. And so ultimately, the property was foreclosed on, and the limited partners, meaning the passive investors who trusted the thesis, lost their capital, all of it. And that is what a real life scenario looks like when the discount was not something, was only what the buyer could only see was the discounted pricing and not really the true story behind the discount and the operational reality. So how do you really tell the difference, and how do you separate that dislocation? And is it worth buying? Is this a deal worth buying, or is this a truly broken deal in a broken market? Well, first, really ask yourself, is this really a defect in the deal, or is this truly a discount? And if it is truly a discount, the pricing should reflect the realities of the market or the weaknesses, right, of the deal. And so Time and sentiment, yes, they recover over time, but underlying core issues, especially if they're outside of your control, do not. A soft market is temporary, but a structural constraint on an asset is not, as in the example above. Second, what is the seller actually exiting and why are they exiting? Not what they're listing. And yes, in this case, part of the story was, well, there is an upcoming maturity, but a deeper question would have revealed the challenges of the market. And then in turn, right, the sponsor would go and revisit their initial underwriting to reflect some of those market constraints, perhaps reflecting zero or no rent growth, extended period to ramp up that occupancy, and factor that into their projections, which in turn would, of course, impact the pricing and may have even led them to conclusion not to proceed with the deal. But doing that deeper diligence on the market and sub-market in this particular case is something that would have helped. And then third, does my capital plan to solve the source of the distress, or does it just rent the problem at a lower basis? And um, this is what the sponsor in the story that I shared with you got wrong. The lower enterprise really did nothing about the constraint that was actually capping the income, and that unfortunately was outside of their control. And yes, they bought it at a discount from the peak, but not necessarily the discount from where the current market realities are and the specifics to that particular deal. And so, if you are a limited partner, these are the questions to put to a sponsor before you even wire $1. Listen to whether the answer is specific or whether it's more general and geared towards optimism. And if you sit on the family office side, run the same logic one level up. The question is not only, well, is the price low, but is the discount actually compensating you for the additional risk that you are inheriting with that particular distress situation? And sometimes it's enough, sometimes it is not. So I will leave you with this. The right question is not necessarily how cheap you bought the deal, but the right question is what the discount knew that we did not. A price tells you what something costs, it does not tell you exactly what you're inheriting. So you have to dig deeper, peel the layers of the onion, even if it makes you cry. So, if this was useful, there are three quick things I want to share with you before I go. First of all, if this is your first time tuning in, follow me here so you could be notified of future pop up live events. I go live once a week where I share my thoughts on the market, particular diligence item or issue, and aspect of multifamily investing. Actually, next week I have a very exciting topic. We're going to talk about tools that you can use as an investor to mitigate risk within a deal. And I will post the link in my comments. I have an excellent guest that will be joining us for the live. If you'd like a second set of eyes on a deal review, message me and we can connect one on one. I'm also running a special summer promotion for those who want to do a deeper dive into deal analysis. So if you'd like to learn more and if you'd like a copy of the offer, simply message me summer or put it in the comments summer and I'll happily send you more information. And lastly, on June 15th, I will be speaking at the IMN Family Office Real Estate Forum. I have a special discount code if you'd like to attend the conference. That's for my followers and audience only, and happy to share that with you. So again, put it in the comments, send me a DM, and I'll happily share. And thank you for spending these few minutes with me. I will see you next week.